Hello and welcome to the Adansonia Capital Global Opportunities Portfolio Update for May 2025. This is our disclaimer. Please read it. To move forward, I'll take it as read. So the portfolio for May performed well in a rising month, where we returned 6.3% against the market, which returned 5.4%. Since inception, the portfolio has returned 16%. Outperforming the index as we define it by 1.34%. Over the month of May, we did not trade. We're currently running with 12 stocks and about 16.5% cash. We're moving away from President Trump for the talk this month. We've basically been talking about Trump and Trump's policies and tariffs for a while, but I thought we'd go and have a look at Porsche. So Porsche is basically in the portfolio. It's a small weight, and unfortunately, it's been a poor performing stock. So this is a little bit of a mea culpa on our part. Essentially, Porsche has been hit by a confluence of macro factors. Essentially, we've had weak consumer, especially in China. Obviously, the Trump tariffs have basically hit the European car sector. Broadly. In actual fact, Porsche has outperformed BMW and Mercedes. It's done relatively well, but basically it's the best of a bad bunch. High interest rates since we basically put the stock in the portfolio have also weighed on the stock, and also we've had higher battery costs through supply chain issues, and also the company strategically pivoted away from battery electric vehicles or full EVs simply because of a slower than anticipated uptake in BEVs. Also, Porsche is largely was hit hard by the Trump tariffs because it has no US manufacturing and has very little to no ability to onshore any manufacturing on the US, given it only produces around 70,000 vehicles a year. In saying that, whether or not it does a deal with its German parent or ex-parent Volkswagen is to be seen, but at the moment, Porsche is basically seen to be largely stuck to have European-based manufacturing, and obviously being hit by the existing tariff regime from the Trump administration. The company also has been hit with some margin compression. Obviously, the retooling of new models and the supply chain issues have essentially pushed prices up, and that's essentially costs up, and that's essentially basically impacted on margins. Even though Porsche is maintaining its pricing discipline, Porsche has not been discounting prices, and they have a value of a volume philosophy for their product range. So effectively, as we see it at the moment, it's about as bad as it can get for this company. Really, it's been hit by a perfect storm, and all the bad news we argue is in the share price. The stock is trading on a prospective 2026 price earnings ratio of 14.5 times. It's offering a 3.8% dividend yield. It's generating a lot of cash to be able to pay the dividend yield. So moving forward, what can turn this stock around? So obviously, it will benefit from a de-escalation of US tariffs. Obviously, Trump is at the moment in the process of negotiating tariffs with 70 or so countries. So essentially, if we move closer towards the 10% base case tariff rate, that will be positive. Or essentially, if there is a cutout for European vehicles, that will also be positive. I mean, there is talk that essentially European vehicles may be hit with a smaller tariff than currently, but there's a quota in terms of what can be imported, which basically still will require or incentivize the need to basically onshore some production in the US. So fiscal 24 and this year 25 are transition years. The company is going through cost cutting and is reducing its reliance on China. Sales into China contributed around 30 to 33% of revenue. It's now down to around 16% as of the last quarterly. Also, as we mentioned before, there's a pivot away from battery electric vehicles, and we believe that new product launches are expected to help revenue growth through additional internal combustion hybrid models. Porsche is very much focusing on hybrid models. the new 911 in particular has basically been received very well. Very much in line with Ferrari, Porsche is also basically looking at offering a high level of customization for its cars than previously, which basically also helps with margins and sales. In terms of sales margins, the company's margins have basically collapsed to a very disappointing 9%. Away from their original 17 to 9% operating margin target, and essentially we're expecting that to recover towards the mid-teens to high teens over the next year or two. And on top of that too, it continues to be favorably compared to its chief peer Ferrari, which is facing the same macro yield in terms of having the same macro issues. Sorry. In terms of having, purely European production in Italy, and obviously having, small volumes but high value. And again, Ferrari is trading on a multiple of 40 times and a 0.8% dividend yield. So again, on an apples for apples comparison, Porsche continues to look relatively attractive to Ferrari, but Ferrari has managed to weather this melee a lot better than Porsche of late. So the upshot of all of this is it's too cheap to sell, but basically we're not. It's on the watch list to add to at the moment. As I said, the company basically has to adapt to the current environment, and obviously what happens with the US will also be very very important moving forward. So it's on our watch list, but again, it has been a disappointing performer. But thankfully, the other 11 stocks have done very well for us. Anyway, that is it for the month of May. I will be basically back in touch for the June update. As always, Tony and I are available for a chat. Our contact details are on the front page, along with the inquiries line for Adansonia's website as well. Thank you, and we'll be in touch in a few weeks.